See, what happened yesterday? The Fed basically did a pause. They did not cut rates. That was as per expectations. What was clear was their economic projections. The summary of economic projections, what's called also the dot plot, that showed that with respect to their December projections, the economic growth has been downshifted. The inflation expectations have gone up. Unemployment number has gone up. And their terminal interest rate also went up. They have projected two interest rate cuts this year, but as many as four of the voting members are now saying no interest rate cut in this year. So that was as far as their dot plot was concerned. What the market found dovish were two things. One, in the statement, they said that the risk for the economic growth has increased. Rather, last year in December, they had said on balance between inflation and unemployment, we are on balance. But this time, the growth concerns they highlighted. So markets saw that as a dovish signal that the Fed will act in case there is a deterioration. Second thing that they did was the quantitative tightening, where the Fed is running off its balance sheet. It's running off $25 billion every year, every month. They have reduced that to $5 billion come April. That represents a stealth rate cut of sorts because financial conditions will loosen because of that. Liquidity in the markets will increase. So that's a kind of rate cut that they brought in from the back door, and markets welcomed that. US markets went up as a result. The US bond yields fell. The 2-year US bond yield went below 4% after many months. And we saw the dollar also going stronger. US is on the mirror image. There, the economic growth is slowing and the inflation is going up. So it's the reverse of India. I think flows will come back to India, but it might take May, June before we find a sustainable bottom for the Indian markets. Right now, markets will be volatile going into 2nd April. Yeah, the Fed is virtually the central banker of the world, so there is a big impact. It's a big event risk that has gone out, and it was a lot of reassurance from the Fed chairman, which is helping the markets today. Asian markets were up, Japan is shut for a holiday. Hong Kong was down because the technology shares were not doing too well. But otherwise, most of the Asian markets were up, and our futures are also showing that we'll open up. The change thing between day before and yesterday was the FPI number in the cash segment was negative again.
Yeah.
Until we see on a sustained basis FPIs stopping this outflows, difficult for our markets to rise. Today, we will cross 23,000 on Nifty. That's a key level. 23,050 is a very strong resistance level. We'll take that out and then short covering will come in. So we might get a good rally for the next couple of days based on short covering coming in. However, one thing we have to keep in mind, what happens on Wednesday in the US following the Fed meeting normally gets reversed by Friday. So I think yesterday, the rise in the stocks, the rise in the bond values as the yields fell down, rise in the dollar, rise in gold, rise in cryptos. It was green all over. So that normally doesn't happen. What we will see is some more sober thinking coming in over today, tomorrow, and we could see a reversal in the US markets. Again, I'm saying if the US market goes down, it's better for us. In the short term, we are very strongly correlated. In the slightly longer term, more flows start coming into emerging markets, where India has a 10-12% market share. We'll also get our fair share then of those reversals. So Today, I think morning session definitely will cross 23,000 and you will see a short covering rally coming in. But we'll have to wait and watch for tomorrow. And then April 2nd remains an overhang for the markets.